welcome back to another episode of Beating Alpha. This is episode 125, and we have two special guests, as you will see them in a few seconds. So first of all, a bit of introduction. So we have Ashton and Christopher Levarek. I don't know, I forgot to ask you how do you pronounce, but hopefully I didn't chop it out. So Ashton and Chris partnered in 2018 to invest in quadraplex in Durham, North Carolina. The goal was simple: take charge of their finances, create multiple streams of income. After successful rehabbing, renting, and refinancing it, to pull their capital back out. They have since founded Valkere Investment Group, that of course you can find on a website, valkeregroup.com. And since they found the company, they partnered with the multiple investors with similar goals to scale their investment portfolio to just over 145 rentals in under 2 years. So that's very impressive. Again, and you can find more about them. Make sure you get into contact on Facebook, Instagram. That's Valkere Investment Group, and LinkedIn, of course, which you can find all those links down below. And again, Ashton and Chris, thanks for joining me today on this episode.
Thank you for having us.
Yeah, thank you. Good to be here.
Oh, it's my pleasure. It's my pleasure kind of talking. Everybody's in a different places right now as we, started recording. So Christopher, you're where? You're in Arizona, you mentioned? Where are you currently?
I'm in Phoenix, Arizona.
Here we go. And Ashton is in Afghanistan, and I'm in Ireland. So here we go. Thank you, Zoom, for making this happen. So good. It's going to be
That's
fun.
awesome.
So guys, listen, I want to ask you a question again. Like multifamily real estate investing is a good place to be in. So maybe you can kind of tell your personal journeys. How did you get involved with the real estate business?
Sure. Go, Ashton.
So I was wrapping up 20 years in the military and kind of looking for that next step. And right at the same time, Chris brought up that he was thinking about investing in real estate for reasons of his own. I believe he, took a hit in the stock market, which a lot of people do. And so we started talking, and he had said he was thinking about getting into real estate. And I had heard somebody else talk about it a few years ago, and I said, well, let's do it. So we more or less had a couple of discussions like that on where we wanted to invest, what we wanted to invest in, buy, and how to do it. And we kind of did a 90-day challenge to get something under contract. And that's, we jumped in with both feet. We learned a lot in that first one. I'm glazing over a lot of stuff that happened, but, a lot of stuff went wrong, but a lot of learning happened. Right. So, but yeah, that's how we started. That was October 2018. So that was exactly 2 years ago that we bought our first property.
Got it. So Chris, do you want to add something to the story?
No, that's a good high level. We did get 2018. It was when we got into it, and part of it, there was kind of a depression in the market at that time, and in the stocks, and a lot of people took a hit on 401k, and I was one of them, and just opened the eyes that there could be another path, maybe a better path, but definitely diversification was something I was looking for, and real estate seemed to bring that. So.
So let me guess. So the first property was a duplex that you purchased, right?
That's correct.
Two
yeah,
duplexes.
Two actually. We decided to just go out and get two right away. But we kind of knew that we
two for yourself and two for Ashton, right? Gonna split it. Yeah, let's split.
That would be even better. No, definitely. Yeah, it was two C-class properties in Durham, North Carolina.
Nice. And can you tell kind of the background? How did you purchase the properties? Kind of if you go through a little bit numbers and do you still have the property?
Yes,
we do. Yeah, and we're kind of figuring out what we want to do with it at this point. It's been 2 years now. We've raised the value, but we purchased it for about $209. So two duplexes, so $104,000 each, basically, which is pretty cheap. If you put that, you're at $50,000 a door roughly in Durham, North Carolina, in 2018. That was pretty cheap, but they needed work. So we ended up putting around, 85, 90,000 into them at the end when all was said and done. So about 45,000 each property. And they're right next to each other. And they were old. So there was a lot of work that needed to be done. I think it was like 1940s. I'd have to go back at the date exactly.
1937, I think it was.
I feel like that date gets lower and lower every time we
Oh, maybe it
talk.
does. I could have sworn it was the 30s, but okay.
So, I mean, it was a price point that allowed us to get into the market. And that's one of the reasons we chose North Carolina. There was a lot of great demand. Raleigh is a huge tech boom right now. They call it the new Silicon Valley. And that's like 25 minutes south, east of Durham. So Durham benefits a lot from the education as well, because you got Duke University, North Carolina Central University, and some big platforms there. So we like Durham, and we like the entry point. You can't find $50,000 door in Phoenix unless you're way out of town, and even then you're probably around 75,000 80,000 minimum. But so we ended up there. So 209 we purchased, 104,000 each duplex, 85 to 90,000 in renovations. We actually partnered with a private lender, so we found someone else who wanted an interest rate, and we did a joint venture together on the property, and they provided 70% of the purchase, and we provided the renovations plus the remaining 30% in closing. And then we did a BRRRR. So if you haven't heard of a BRRRR, we just did all the renovations. We bought it cash, did all the renovations, then went to a bank at a 6-month seasoning period and refinanced out our capital. So took a new loan that was able to get out our capital.
Got it. So you got a little bit greedy at some point, and it was like, I need to move away from duplex and from Durham and go to the Burlington and get the 5-unit. So can you talk about that? How did that come across?
Go ahead.
Well, actually there was a couple more before that one, but it was just, we knew what we want. What happened was Chris and I sat down and we figured out where we wanted to be in 3 to 5 years. Actually, I think it was 3 years, but what kind of income do we need to sustain the lifestyle we want in 3 years? And then how many units, how many rentals would it take to get that? And so when we really sat down and thought about that, that's when we decided we really need to start getting after it. And it just made sense. We listened to all these podcasts, we read all these books, people talking about being able to quit their W-2 job. Not that we actually wanted to quit our W-2, but having the freedom to do that, right? That's what drove us to get greedy, if you will. We were looking to create more opportunity, and I think we did 1, 2, 3 duplexes. Is that right, Chris? We did 3 or 2 duplexes, and then 2 more duplexes, and then we did a 5-unit in Burlington. And the 5-unit was the first commercial property. And I think we did a couple things right, even with that first, quadruplex or 2 duplexes that we bought, because we didn't live there. So we built a team around that project, right? We had a broker, we had a lender, we had contractors, we had a property manager, we had all that set up. So it was kind of like an easy next step. I think the property manager even brought us those deals, if I remember correctly. And so, and so it just made sense. We just started rolling forward. And the other thing we did, that we did it on accident, just by necessity, was partnering with someone else. In the beginning, I think a lot of people think they need to do it alone. And we had a friend that came into some capital and wanted to get into real estate, and we were going to do all the work, and he wanted to invest. And so it made sense. And that kind of we never thought about it till later, but because when you talk to people, they're like, well, I don't have the capital to get into it. Well, find other people that do. And we fell into that, and that really helped us, because then we started looking for more people with capital. And then you start realizing, like, man, if I start building my network, I can get even into bigger stuff, right? And so every deal we've done since then has been through partnerships, through partnering with other people, whether through joint ventures, through private money lending, through syndications, and so on. So it kind of just snowballed into this bigger and bigger thing, and it created more opportunity, as well as created, your eyes get bigger than your mouth pretty quick. You're like, whoa, we did this 5-unit, let's do a 13. Oh, we did a 13, let's do an 84, and then a 120. But it's very possible. But people, I think people switch that off in their brain and they think they have to do everything themselves, which is not true. In fact, the more people you get involved, the easier it becomes. So I don't know if I answered your question. I kind of roundabout how we got to that 5-unit, but our property manager brought us that property, and we're refinancing it right now. to pull out the capital. So it takes a little bit longer to season a commercial property, and anything over 4 units is a commercial property in the US. So we had to let that season. I think we bought that late 2008. When did we buy that, Chris?
It was July 2019, actually.
There we go. Okay. So yeah, just over a year that we let it season before we refinance.
Got it. So what about the other 29 units? I mean, you have the 13 units and you have the 16. When did you acquire those?
The 13 unit we closed on, end of 2019 as well. It was right after the 5 unit, I think.
Yeah, actually, right, the 5 unit would be slightly before that. So it's probably April, May timeframe. The 13 unit was July. And then at the end of July, beginning August, I believe, we had a 16 unit close as well. So we kind of had a busy 2019.
Yeah, 33 units when it comes to multifamily deals. So that's awesome. I mean, there's quite a lot, So how did you find those deals? Was it through, broker, property management, relationships?
Yes.
All of these.
All of those. I will tell you this though, we didn't do any active, like everybody thinks that you have to go out and actively like drive for dollars and hunt down these deals. That's something else that, we've gotten good at is building up a team and building up our network. Mm-hmm. And I highly recommend people that are looking to do this, build your network out. Try to be the business owner and not necessarily the person working in the business, So we developed relationships with brokers, with property managers. And as you start doing that, and as they start to trust you, and once they trust you, they bring you deals because they know you can close, or, and that's how it happened. It wasn't, like I said, it was a natural occurrence. It felt like we were hustling all the time, but looking back, it really was all relationship based. Mm. What'd you say, Chris?
Yeah, for sure.
Here you go. So
I mean, we were hustling though. But.
So do you mind me if I ask you the kind of the secret recipe that everybody wants to know is like, how do you build those networks and relationships, and how long does it actually take for somebody to trust you that they will invest in your deals?
Yeah, I mean, the easiest start, of course, is friends and family. So it is a relationship driven game. Whether you're partnering with people they're filling a role in the business, or whether you're partnering with people because they're raising capital, or you're bringing capital, which is a role in itself. It's relationship driven. So if you have that relationship established already with friends and family, it's easier. But if you don't have that relationship, you need credibility and develop the relationship. So credibility is my experience. It could be a bunch of things. If you don't have the credibility, you partner with experts, like an attorney, like a property manager, or like a contractor who does have the experience, which gives you credibility. If you match that credibility with building a relationship with a new person or an existing friends and family, which will be easier, then you can bring both of those to bear, and it'll be easier to find that capital, find those partnerships.
Got it.
That makes sense.
Mm-hmm. Good. Okay. So please.
No, I was going to say, I actually had a conversation with another person that is looking to get into real estate just yesterday. And that was one of the things he asked. He's like, well, how do I build credibility? Mm-hmm. And I said, I bet if you turn around to your family, you already have credibility. They already know you. They already trust you, right?
Unless you're doing something completely wrong.
Right. Right. I mean, you do have to have a solid, you do have to have a solid, business plan, but like, that's the best place to start, is people that know you already, that trust you already. That's your credibility right there.
Got it. Good. Love it. Okay. So moving on from North Carolina, I mean, probably through relationships, through networking and building that network, I mean, you came across the 84 unit deal in Columbus, Ohio. So how did that came about? I mean, and for what reasons, and how did you are positioned to yourself? Are you GP, LP in the deal, and what's the story behind that?
Well, so again, I hate to give the same answer over and over, but we were building relationships with a lot of people, and that was kind of that was kind of our process the whole time. It's like, how do we build a big enough network to actually be able to take down these deals? We never actually thought we would go partner with other general partners. We were always looking for limited partners. We were always looking for people that wanted to bring capital, and passively invest in one of our deals. And then we were also looking to build relationships with people on the ground. So like the brokers and property managers in those areas. But because we were reaching out so much and we were talking to so many different people, we were going to meetups, we were going to virtual meetups, which there became a lot. You get to know people. You start you start talking with them, start drinking with them. We host our own mastermind, Wealth and Whiskey Mastermind, where we all drink whiskey and just talk about real estate and business, And a friend who had been going to that, he said, "You guys are getting into multifamily and you're doing awesome. I want to introduce you to somebody." And so we had a couple meetings with this other gentleman, Stephen Libman. He has his own podcast and he's out of New Jersey, actually. And we just developed a relationship over 6 months or so. And 6 or 8 months, I can't remember. And we had several, like we never met in person. We actually just had a couple drinks talking over Zoom, And then out of the blue, he's like, "Hey, I'd love to have you guys partner with me on this 220 unit that I'm working on in Columbus, Ohio." And that's how it started. And we're still partnered with them today. That 220 unit is still up in the air. It's gone back and forth, so I won't go into that one. But that's what catapulted us into that partnership, which allowed us to get into an 84 unit. And then we closed on that, last month? And then now we're closing on 120 unit hopefully this week, but possibly next Monday.
And it's in Texas, by the way, right?
That one's in Texas, yes.
Different market. So when it comes to the markets, you're in Texas right now. You're looking to close the deal in Texas, Ohio, and you're in North Carolina. So is there any other markets that you're looking forward to investing also?
Chris?
Yeah, I like Phoenix too. It's just so competitive here, and Dallas is too. But all of these were off market that we're on at present. So it is about relationships again. But Phoenix is the same. It's off market. If it's already listed, typically they're not even going to put a purchase price. It's going to be offer based, and you're going to go into first and second rounds and all that. So best and finals.
So what does it take for you guys when you come across deals? What does make a good deal for you personally? Can you talk about your investment criteria?
Yeah, absolutely. I think Chris can weigh into this too, but I want to caveat onto or piggyback or whatever on what the last topic. So how we pick a property has a lot to do with how you pick a market too, right? The markets we look at are in states that are typically landlord friendly, that make sense to own a rental property in, that you're not going to lose money on because of the laws favor the tenants. And now I don't want to say that and let anybody think that we're, buying properties and running them as slumlords. We're providing good, affordable housing, but at the same token, we're not trying to allow, like places like California, you can get away with living for 6 to 12 months rent free just because you're a squatter at that point, and you have no other place to go. So that's not a place we would look at. But so we look at those states first, and then we look at, job growth, population growth, rent growth, unemployment. And we like those to beat the national average in the markets we invest in. But that is the start of how you look at a property. Because we get sent properties all the time, and the more detailed you are about what you're looking for, the easier it is to say no, and then you don't end up wasting a lot of time. And I'll let Chris is a little bit better at the numbers than I am. I'm not the numbers guy, but I'll let him go into the numbers of the actual deals that we look at. But that's where we start, is the market.
Yeah. Typically we're looking at the C+, B- range of type property. Different market is going to have a price per unit. And we've focused, in North Carolina, I would say our price per unit was around 50 to 70,000, 50 to 60,000, depending on where we're at. Because that's one of the reasons we like the market. It's an easier entrance into the market. And when you're getting started in real estate, and when you want to build credibility, for sure, if you're building a business, you need to add unit count as well to your portfolio. It's just easier to enter certain markets with the capital you have at hand than say if I went to Phoenix, and I'm buying 110,000 to 200,000 a unit, I might be able to get a fourplex for what I could get in Durham, a 16 unit. So there's that consideration. So we've been targeting around the 50 to 70,000 price per unit, a C class, B minus. So you're looking like 1960s, 1990s, because it's varying a lot more now. But we've been more on probably the 1960s, 1980 range of property. So those need value add, and that's what we look for. We look for value add. We're going in. We typically don't do like a big flip. We started with that. That's how we got in the first duplexes, and now we've realized, you need a really good expertise in that area to understand, what your price is going to be to renovate a property that's been from the 1940s. So typically we like to simply increase rents, 100 to 150, and that means about $5,000, $7,000 per unit to renovate them. So we come in, we slowly turn over the units. We're not going to empty or liquidate the entire property. We're going to slowly, as leases expire from the old seller, slowly turn over those units, raise rents to 100, 150. And with that value add, then we're able to provide a return to investors. We like the value add approach. We haven't done development. We haven't done like huge luxury flips where we're taking a B to an A or something like that. We typically like just enough value add where the competition, the competing apartments around these properties are showing that market rent, and we are under market rent by 100, 150. So that's kind of our criteria. And Columbus is a great market for that. I mean, number 3 university in the United States, the Ohio State, the biggest employer in Columbus is the government. So there's a lot of stability there, and the state. And then Columbus, Ohio is actually the 3rd. So there's a lot of opportunity in Columbus and a lot of structure that supports. And then there's a lot of these value add properties that have just been, this one was a 1963, this National Road, and it had like 28 units that were just down because the seller didn't want to comply with the state and some other reasons there. But that's why we like Columbus. When we get to Dallas, you see a different price point. We're 30 minutes out of Dallas in that property, Greenville, Texas. But still a lot of opportunity to commute in. And, but that price point was about 76,000 a unit. So you start to see these differences, but the rents will be a little higher around the Texas market versus maybe say, Columbus or Durham area. So.
Okay. So again, when it comes to development, maybe you can ask Steve Libman. I think his company has been involved into building storage units, which is probably a little bit lower cost and still provides some great returns. I don't know if you spoke with him about that, but it's like what he does is very beautiful. So he's definitely a good man. So one thing that I wanted to mention is, so your clientele that you're looking to buy from you, we're talking about kind of mom and pop type of properties, which will be like, are you looking for a very heavy value adds? Like how much are you spending like on renovations per properties? Are you using kind of cookie cutter approach, or it's based on the properties?
It's pretty typical the same each time. So we're going to do some exterior renovations as far as, if there's foliage, new lighting, repairing, of course, any kind of like, it's say the streets are inclining and you got like a river pooling or something. Those are obviously some fixes we'll do on the exterior, but you might add a dog run, you might add a playground, just make the outside a little more attractable. We're not going to go, put in a giant pool or something like that unless, it really warrants it. But besides that, I mean, yeah, it's fixing what's broken, of course, but it'll be about 5,000 to 7,000 per unit. So if let me see if I could see National Road, it'd be somewhere around 800,000 in renovations for say a $3 million property for 84 units, for example. So, it's going to be 7,000 a unit roughly. So we'll come in, we'll paint the interior, we'll put new LVP flooring, new usually kitchen cabinets, or repaint them or make them look nicer, new appliances if needed, and then some bathroom vanity, touch up the bathroom if needed. But we're not going to go in and do nice new tiles and huge backsplashes unless it really warrants it. We're raising that value just enough to get that rent increase of 150, 100 per unit.
Got it. Got it. Okay, awesome. So Arizona and Afghanistan currently, which of course, by the way, this show will come out, you'll be home, so welcome back. And
Thank you.
one question that I wanted to ask you is, how do you, manage the properties? Because like, do you have like a third party management, or you kind of vertically integrated your own property management? And maybe you can go through kind of the vetting process on hiring one also.
Yeah, we have third-party property management. We don't have anything internal yet, although we did. We did partner with our property manager on this last two deals, which helps because now they're vested in the success of the property itself, right? So I don't think you can call that internal, but it's almost. But they're definitely heavily involved. And how do we vet those people? I think that goes back to how we vet anybody. We want to make sure we like them first, and then we trust them. And so, we meet with these people, we have several meetings. You got to look at it like you're hiring for a job, which you are. They're looking for your business, but you're also looking to work with them on future deals, I would hope, right? And that's been our experience so far. When we found a good property manager, we continue to bring deals to them. So it's been a lot about building that relationship, with somebody you like and you trust. And then I think how we did it in the beginning is we actually had them walk properties with us. We want to find people that were investor friendly, that wanted to grow. They're not just there to like add numbers to their portfolio of properties under management. We wanted people that actually wanted to grow their portfolio and work with you and be profitable for the long term. So like our first property manager, he came out to every property we were going to buy. In fact, when we were not even in town, like I wouldn't even be there, and he would go walk properties for us and tell us it's a good or a bad deal. And we took that with us all the way up to, these 84 and 120 units. When we partnered with Steven, that was the same method. Everybody met out there to do the due diligence. We all went out there, including the property management company, and they walked the properties with us so we could get a feel of how they felt about it. And we're looking at the same thing, we're coming up with the same idea. I mean, they have more experience on that matter, but that's really what we're looking for. We're looking for people we like and we trust, and that know what they're doing. So you're looking for that track record. But yeah, build that relationship.
Chris?
Yeah, that's big. We are pretty open book and honest, and sometimes I think that gets criticized on the social media part because we're very vocal and we say what we think, and our partnerships reflect that, though, where when we meet up, we're not going to sugarcoat things. We're not going to not talk about our kids or not talk about other things other than business. And those are where the great partnerships get formed versus just doing business and negotiating and you get this if I get this, and those don't end well. So we like to have partners where we talk about our kids, we talk about other things that we're doing. We like connecting outside of work and actually seeing a person face to face, or at least doing these Zooms, with what's going on. And that's how we do vet people. That's how we've done it. We do go by reviews and we do look up their past experience, of course, and we do have a vetting process there, but it's big on character and personality. And it hasn't led us wrong so far, for about 90% of our partnerships. Of course, we learned with an early property manager in our early experience, but from those experiences, you do learn that personality and character are huge in this business. So
beautiful.
Plus, it makes it more fun to work with those kind of people, right? If you get along with them, it's easier to work with them.
Yeah.
How about that?
And I love the fact that you're being, I love your approach, because you are who you are, and you're not looking to shape yourself and become somebody else like that. You're not you, right? You're gonna still being yourself, and you're looking for people that would be on a kind of a little bit similar frequency, same as you, right? So we can talk about similar things, and you can be open on the same level, and discuss similar things, and that's beautiful. Instead of changing who you are, you're just looking for the people that are similar to you, which is really cool.
Definitely.
Yeah.
It's the same too when talking to investors. I'll say this last thing. It's a partnership there too. So sometimes we will have investors who don't understand what we're doing or don't like it or want something different, and that's fine. we're not going to force you and you shouldn't force us. It's a cohesive partnership that gets these deals done. So it's important on all fronts.
Got it. So one thing that I wanted to ask you, because when we started conversation, first of all, with Ashton, and then you joined us, he mentioned a software. So maybe you can talk about what type of softwares are you guys using to kind of maybe observe the operations on a day-to-day basis, or maybe, the ones that help you to manage operations better?
Oh, sure. So I'm in IT, so that's kind of like my zone a lot. There's a lot we use. I would say there's some critical ones that anyone looking to get in this business should use. Some kind of project management tool, so to coordinate your deal, how you're working on it, who's got what pieces of it, what's the ownership, where do you track all that? We use Monday.com. So it's helped us. We have about, 8 different people in there at any given time, and you can easily comment each other and, put a bunch of details in there and have it kind of like a dashboard. So that's been useful to track the deal. And then to track, investors, we use Pipedrive right now. So, where's the communication with this investor? What are they looking to raise? What have we, in each meeting you have with them in Zoom, you can take notes within there. You can have their contact information. That's what we call a CRM. So Monday.com can act like a CRM, but it needs a little configuration. And then you need an investor portal. We use Syndication Pro. So basically when an investor logs in, what are they looking at? How can they review a deal? How can they, see if they like the PPM and the legal documentation? We put all that in Syndication Pro. It's a 2-factor authentication, meaning, if we put the wire info in there, which we do, we don't put wire info in emails. You don't have to be worried as much that someone's going to take that wire info when you share it, which is a big problem in syndication sometimes. The sharing these wire details via email can be hacked really easily. So Syndication Pro, a secure investor portal we use. And then we got all the little ones, of course. We have Calendly for setting up meetings. One big one is Zapier. It's a great tool for linking applications together. And so we use it to tell us all the time what's going on. So we have Slack, and if we didn't have Zapier telling us, oh, this person signed up for that, and this person reached out with a Calendly here, it sends those notifications to Slack, and we get all that automatically. So a lot of moving parts there, but it's about developing that process map of what you're trying to accomplish, and then finding the tools that will get that done in as much an automated process as you can, so that you don't have to go checking all these boxes and tweaking all these things every day or every communication. So
beautiful. So again, that's kind of your thing, and that's what you do. So I'm pretty sure you're managing everything pretty well in that section. But maybe Ashton wants to kind of add something to that too.
That's horrible. I have to learn all this stuff. But I will say, for your listeners, my brother wrote several blogs on it, and you can check those out at our website.
There you go. And
he lists out the benefits of each one of those apps. And really, like, if you get a couple of those apps, I think the easiest way to learn is go on YouTube. I mean, Chris is sending me YouTube videos all the time. Like, this is how you should do this. Check out this video, So that stuff helps. But yeah, it'll definitely help your business. I highly recommend looking into those apps.
Got it. So another question kind of for Chris, I think, because I would love to kind of get your personal experience and your thoughts on, because you spoke about like losing some money in the stock market. So maybe you can talk about, again, first of all, how do you structure the deals by the SEC, regulations, the way it looks? I mean, what does it take for somebody to invest on those deals? And again, why is it better than the stock market? And again, maybe you can talk about your personal experience with that.
Sure. Yeah. So we've done 506B mostly. So that's it's usually friends and family, people you have an established relationship with, versus say a 506C. And these are exemptions for allowing, say, someone to raise capital to buy real estate. And if they don't have certain licenses to do so, this allows a private company to raise capital if you're not familiar with those. But there's typically a 506B exemption, a 506C exemption would give that ability to a business to raise capital. And we do a 506B. So it just means we can have 35 non-accredited investors. So people who don't make over 200,000 in income alone, or 300,000 as a joint couple, or 1 million in net worth. So that means they're non-accredited if they're under those limits. And so we look for those type of investors mostly. We will get accredited investors as well. And then we've done it a couple different ways. So we've done just the traditional split where it's say 30-70, so 30 GPs, 70 to LPs, limited partners, the investors, and had, just traditional raise with, I guess it's more the traditional method where you're raising just for one property. And then we've also done a fund. So a fund is basically very similar paperwork. It's a PPM, like you'll see with normal syndications, but it would say, instead of saying this money can be invested into these specific properties, it will say this capital can be invested into multifamily properties satisfying this criteria or something like that. And so in those cases, that gives a little more flexibility to both the investor and the capital raiser. But again, all those are signed ahead and you're discussed with each investor and with each general partner that's on that fund. But why is it sorry, my phone's going off.
No worries.
Why does it make more sense? I look at it from diversification, so stock market has its benefits. There are people who are really good at picking stocks and really good at, there's some index funds which have a decent track record. And if you really examine when these index funds lose money or when they make money, that's another discussion on if you're actually getting back to even, when you lose money or make money, because there's a loss of time in there. But regardless, I would say that stocks become really hard to understand for the common investor, because there is a lot of things in stocks going on that we are not aware of. So for example, say I always come back to this example because I find it hilarious. The owner of Tesla, Elon Musk, he smokes a joint on the Joe Rogan show, and all of a sudden Tesla stock just dives. That has zero to do with the business plan of Tesla. Yeah. It has nothing to do with the business plan or their numbers or how the stock is doing, how the company's doing. That's just, personal opinion of how Tesla is. So those things we can't control in the stock market. And that stuff happens a lot. China does something and then all of a sudden the stock market dives. That has nothing to do with how those companies are doing. It has to do with the public opinion of what China's going to do to those companies or those effects. So why I like real estate is because it's tangible. You can see it, go touch it. You can look at it. You as the investor can go find county tax records and actually verify data that is provided to you by a general partner. You can see how this property is done over time. You can look around the surrounding area. You can go now with Google Maps and look, is this a nice area that I want to invest in? And you have so much more visibility into it. And then the business model. It's not too hard to understand that if you add value to a property, you can raise rents if the surrounding market supports those rents. So that makes sense to me as an investor. I'm adding value, I raise the rents, my income for the property goes up. Okay, it's much easier to understand than, okay, Tesla put out a new truck and they threw a baseball at it and now everybody doesn't like Tesla because the window broke. Like that's not a business model, that's public opinion. So that I keep picking on Tesla, but that's that's kind of how I see it.
Elon is just going to send a quick tweet and the stock is going to go back again. So don't worry.
See, there you go. So that's kind of how I see it. Is the visibility, the understanding is much easier for someone in real estate versus a stock market. We're trusting a lot of financial managers, which is good. In essence, you're doing that when you invest into a deal in real estate, except you as the investor can take the time to understand the product where it might be a little harder to understand that stock. So
got it. So Ashton, for you, when you come across people and they ask you the question like, why should I invest into multifamily? How the conversation go between you and that person?
Well, I usually quote people that are smarter than me, and Chris always makes fun of me for it, but I like quotes, and they make sense. You know, they add value. They add value to what I have to say.
Yeah.
And so if you look at what Charlie Munger says, if you look at what Warren Buffett says, they say diversification is just protection against ignorance, right? It's for people that don't know how to manage their own money. They say, hey, stockbroker, take my money, invest in something you think is going to make me money, right? Whereas you can turn around with real estate and you can make real estate simple. It's simple. You make money with the appreciation of the property. You make money with the cash flow from the rents. You make money because your tenants are paying the mortgage down. And what was the last one? You make money on the sale of the property. Like those are 4 ways you make money on all types of real estate. Never mind the tax benefits. You know, there's tax benefits out the butt on real estate, and it really helps you out. So I don't know I don't know any stocks that do that. I mean, correct me if I'm wrong. I mean, yes, you can get, I forget what they call it, but you can get cash flow from certain stocks, but that's not very common. Like, and most people don't have the background to do that, but the majority of people have the background of living in a home and they understand how that works. You have to pay to live somewhere, and people will always need homes. People won't always need Coca-Cola, you know, or whatever other stocks out there that are doing great right now. But they will always need homes, right? So, you know, I think a lot of people are always like, oh, you got to diversify. And I think like Charlie Munger says it, I think it's just excessive diversification it's not as safe as you think it is. You're not going to win all that big, you know, with diversification. The more diversified you are, focus on something and get really good at it. Maybe real estate's not the thing you want to get really good at, but for us it is. And we can control it. We can add value to it, and we can turn around and sell it and make a profit off of it. And at the same time, you're providing housing to, you know, other Americans or wherever you choose to invest, you know, and so that's something you can be proud of. Yeah. That's why I like real estate. Yeah.
One last thing I'll throw in there,
please,
that you didn't cover, Ashton, because you were missing. You had 4 there. I'll just throw it out there. Leverage, right? Yes. So when I buy stock, I spend $1, I get $1 worth of stock. When I buy real estate, let's say I buy at 20% down, I'm getting $1 worth of, you know, real estate for 20 cents.
Yes.
You can't do that in stock market, right? It's a 1-to-1. So big advantage in real estate, just there.
Got it. Yeah, that's a great point. So I love what you guys have covered. You know, it definitely makes sense, and everybody who has the common sense definitely will invest in real estate, and particular multifamily. And the stock market, of course, that's what the Wall Street people want you to do, to diversify, because that's how they make the money, right? When you diversify and they make the money from fees. But thing that I wanted to ask you guys again, 120 units you're looking to close in Texas. So maybe you can talk about what's currently going on in the pipeline, how many deals maybe, you know, Chris, personally, you're looking at actively, and what are you planning to close on, and maybe the number of AUM you're planning, like what's the number you're planning to close on this year?
Yeah, I think these 2 deals will probably round out our year. The 84 unit and the 120 unit that we've closed up to yet. It's not off. It's, you know, we're still open to opportunity. We have found raising over the holidays is kind of interesting, because it's hard to get communication to investors and get timely feedback in time. But we're looking at a couple different opportunities right now. We're looking to close this 120 unit. It's fully funded at this point. So we're simply looking to get all the final paperwork done in a timely fashion. But what I'd like to do, and we're still discussing this, we have internal company meetings going on, but I'd like to really focus on working on the business at this point for the next 2 months, really create some of those automatic, you know, communication workflows. I'm looking into Active Campaign as a big one. So more tools, but I'd like to work on some of our processes and get our business a little more automated in that function. But that's my goals, you know, so.
Ashton?
We're working that. Yeah.
So if you haven't read the book Traction, I think it's a great read if you're looking at starting your own business and how you're going to organize it and who needs to sit in what seat and what jobs need to be filled or roles need to be filled. Highly recommend it. That's one of the books that really helped us organize our business. And we still have weekly meetings, monthly meetings, quarterly meetings that reflect everything from that book. But you know, you'll see a big difference once you read that book. You can tell, and you listen to this podcast, I bet you can tell who is who in our business. I mean, my brother, he is the integrator. He is the guy that he's really good at finding all these systems and these processes to make everything move smooth and work it out. And he's very detail oriented, whereas I'm a little bit bigger picture oriented. I'm looking up and out, and I don't care too much about the details, which is good and bad. I mean, it's good because it's always pushing people to move forward, but it's bad because a lot of times I'll jump into something both feet without doing the research. But so, you know, just given our answers off of this, like my goal, our goal for this year, you know, we wanted to close on so many units. We want to close on 500 units by the end of 2020 or 2022. So that is our ultimate goal. And then how we get there, you know, we have a whole campaign on how we're marketing and branding ourselves and growing our network. And that's part of what Chris is talking about. He wants to systematize that and perfect that so that it's a lot easier to do, so that we're not scrambling at the end there, you know, organizing everybody, you know, getting all the wires in, finding the deal, whatever the process is. So yeah, I mean, we each have different goals, but they're going to be, when we sync them together, that's when it makes the most money, right? Or not figuratively and literally speaking.
Got it. So the book is called Traction, Get a Grip on Your Business. Is that the book?
That's it.
That's a great
the
one.
Gino,
Yeah.
so Gino Wickman, make sure and grab it, anybody who's watching or listening. So again, the last question that I have, and if we start with Ashton, you know, like, because you're meeting a lot of people, you're being on a podcast just like this one, which I really appreciated, you know, for your time today. And you speaking with a lot of people, and, you know, just on a day-to-day basis, you know, potential investors or just people looking to educate those people about the benefits of real estate investing. But what is like the one thing that you want people to remember about you when you meet them?
The one thing I want people to remember about us is that we're family focused and we like having fun. That's it. I mean, you know, everybody's always about these are the returns we promise, and this is who we are. We're focused on, you know, creating, you know, a business model that does this and this. I mean, at the end of the day, if you don't enjoy it, if you don't enjoy who you're working with, partnering with, you know, and investing with, like, it's not worth it. You're going to be worried the whole time. I just listened to a great podcast by Simon Sinek, and he talks about that, how to say no. Like the best choices he made are the ones where he said no to somebody because they didn't already trust him. And I want to work with people that trust me and want to work with me. And so I think that's the big takeaway for me anyway. Right now in my life, like I want to work with people that make this fun. You know, Chris and I, we're not trying to build a business to create another job so we can quit our current jobs. We wanted to create this business so we could create a life that we enjoy, right? You want to go on vacation with your family. You want to go, my family is my business now. So I love it. And that's those are the kind of partners I'm looking for, that people that want to do that. So.
Here you go. Chris?
Yeah, so I mean, I'm just thinking about all the different calls I take and what I want to be remembered as. A big one for me, like Ashton said, I'm a little different personality. I do want to be recognized as, you know, being able to provide value to people and being an expert in some of these areas of real estate. You know, we're constantly learning, and I understand, you know, I get ahead of myself. I want to be the best there is out there, and sometimes, you know, you gotta put your time in to get there. So I really want to be recognized as someone who understands this product, someone who provides value to investors, but also, just like Ashton said, I want to enjoy the process too. There's no kind of rush to the finish line. You know, and in the beginning, I think we started that way. We were trying to get there as fast as possible, or at least I thought so. And that wasn't that fun. You know, this should be fun. This should be fun for both sides of, you know, for limited partners, general partners. We're doing something great. We're bringing value to properties. We are buying into good assets that have good returns, good tax benefits, and all these advantages that we've mentioned. So it should be fun, though. It shouldn't just be, I'm out here to make money and, you know, let me sign the contract and we're done. You know, like, it should be a fun process, and that's where I want to keep it. And that's, you know, what I want to be recognized for is honesty and, you know, a good partnership and having fun while we're doing it.
Awesome.
And that brings up a great point too, because I think a lot of people, talk about syndications, it's all about finding the deal and finding the investors, but nobody ever talks about the business plan for the next 5 years. Like you are in a relationship with these people that you partner with.
Yep.
And if you don't continue that, that relationship, if you don't continue that communication, like you're really, not only you're hamstringing your business, but I mean, that's just, I don't know, it's just mean, you know, like these people came, these people came in with you, you gave them this great opportunity and we're partner now and we're in this whole deal together. And then you buy the property. All right, we closed and you don't hear from us for 5 years. Like, I don't think that's.
Yeah, because there's some people, I'm sure majority of them, I'm sure that, or at least I hope majority of them are focused on serving people, because that's happens when you, because again, that type of situation happens when people are focused about themselves. Like, look, I want to get paid, I want the fees. And I do understand that's why they go into business, because they want to keep the lights on, they want to expand the business, they want to get paid, they want to support the family, the communities, they want to, you know, leave an impact maybe with the, you know, different things, you know, like charities and such, you know, things like that. But you have to focus on serving people first, putting people first, you know, that's basically
absolutely.
Yeah. Awesome, guys. So I really appreciate you joining me today on the episode, and can't encourage enough of you who are watching this episode to get in contact with Ashton and Chris. And those links are down below for you to do so. Make sure you get in contact, ask them the questions. How do you invest in real estate? Why do you invest in Texas, Ohio, and North Carolina? What reasons? How do you underwrite the deals? All these good questions. And I'm sure they will spare you some time, you know, on answering these questions. And one thing that I wanted to ask you also, if you share this episode with a friend of yours, that person who always talks about real estate investment but never pulls a trigger, I'm sure that person will always will find great information on strategies, tips, techniques, inspiration on multifamily investing, whatever that is, active or passive. But Ashton, Chris, really appreciate you being today on episode. I learned a lot from you guys, so thank you.
Thanks so much for having us. Yeah.
Thank you. Again, guys, make sure to share the episode. And as always, I'll see you next time. Thanks for watching.